In this video, we're going to be talking about borrowing money, about your credit, and about debt. First, it's very important to understand the options that you have for borrowing money and what you should watch out for when you make this decision. There are two different types of loans. An installment loan is usually repaid in equal payments for a specific period of time, usually several years. A revolving loan allows you to make unlimited purchases up to a pre-approved dollar limit. Your payments will vary based on how much you've borrowed. There are other ways to purchase items which are typically not loans. For example, rent-to-own services let you use an item for a period of time by making monthly or weekly payments. If you want to purchase the item, your rental payments will be partly credited toward the purchase price. Buying on layaway involves putting down a deposit, usually a percentage of the purchase price, and paying the balance over time. You take the merchandise only when you have paid in full. Be sure you understand the refund policy too. Finally, there are also secured and unsecured loans. Secured loans require collateral. You pledge collateral to support repayment of the loan. Collateral is an asset you own, such as your house, vehicle, or cash. If you can't repay the loan as agreed, the lender can take your collateral and use it to get some or all of their money back. Unsecured loans are made based only on your promise to repay the money you borrow. They don't use collateral. There's always a cost to borrowing money. The amount you repay on a loan will generally be greater than the amount that you borrowed. So let's go over some of the terms that are important. First, there's the principal. The principal is the amount of money that you borrow. Interest. Interest is the amount of money a financial institution charges for allowing you to use its money. It's expressed as a percentage. There are fees. Fees may be charged by financial institutions for certain activities, such as reviewing your loan application and servicing the account. Prepayment. This is early repayment of all or part of a loan. When you shop around for a loan, find out if a fee could be charged for prepayment. It's called a prepayment penalty. Also, it's important to know about co-borrowing and co-signing. Co-borrowing is taking out a loan jointly with one or more other people. In this case, each co-borrower is responsible for repaying the debt. The payment history appears on the credit reports of each of the co-borrowers. Before you co-borrow, have a clear agreement with the other co-borrowers about how much of the loan payment you will each pay and other responsibilities that you might have for the loan. Now, co-signing is different from co-borrowing. The loan proceeds go to the borrower and not to you as the co-signer. When you co-sign, you promise to pay the debt if the borrower does not. If you decide to borrow money, it's important to understand the terms of the loan before you commit to it. You should always know how much money you're borrowing, how much money you have to pay back in total, how much money you have to pay back each month, and when the payments are due. Now, let's talk about a very important part of your financial security, the credit report. A credit report is a document that contains your credit history. Credit reports are going to list your identifying information, your debts and some of the bills that you pay, public record information, your applications for new credit and other inquiries when lenders or other businesses request a copy of your credit report. Equifax, Experian, and TransUnion are the three nationwide credit reporting agencies. If you have a credit history, you'll likely have at least 3 separate credit reports with those different agencies. So now, what is a credit score? Credit scores are numbers based on information in your credit reports. Credit scores predict how likely you are to pay your bills and debts as you agree. There are multiple producers of credit scores. If you have a credit history, you'll likely have several different credit scores. Higher credit scores indicate you've paid your bills and debts as agreed in the past and are likely to do so in the future. So who uses credit reports and scores? Credit reports and scores are used by financial institutions. They're used by landlords, utility companies, sometimes cell phone companies. Without a good credit history, you may have a harder time getting a loan or renting an apartment, getting a favorable cell phone plan, obtaining some jobs, or turning on utilities. There are two significant factors that affect your scores. One, whether you repay your debts on time and as agreed, and two, how much you currently owe on each account compared to the credit limit or original loan amount. This is your credit utilization rate. Different lenders, businesses, and service providers use different criteria for what they consider to be a good credit score. Now, exceptional and very good, that's 800 and above. That's a great credit score. If you're scoring between like 740 and 799, pretty good. 670 to 739, fair. When you get into the 669 and below, down to 580, that's poor, and anything below 579 is considered a bad credit score. Each lender will have its own method for determining whether you're a good credit risk. So they might look at things like your credit or your character, how much you've paid your bills or your debts, also your capacity. So that's your present and future ability to meet your payments. That's your income. Your capital. So that's the value of your assets and your net worth. And then also your collateral. That's the assets that you might use to secure a loan, particularly the secured loan that we talked about. You have the right to accurate information in your credit reports. The only way to determine if the information is accurate, though, is to get and review your credit reports regularly. Federal law requires consumer reporting agencies to provide you a copy of the information in your report if you request it. The law also gives you the right to one free credit report every 12 months from each of the nationwide credit reporting agencies. Annualcreditreport.com is the only place where you can get the free credit reports you're entitled to under the law, so watch out for any imposters. Now, let's talk about some of the things you can do to build your credit if you need to. You can get a secured credit card. To get a secured credit card, you must make a deposit with the financial institution that issues the credit card. Often it's around $500, which is also generally the credit limit. The credit limit is the maximum that you can charge on that credit card. Another thing you can do is to get a credit building loan. These are installment loans, usually for about $1,000 or less, and then you repay them through regular scheduled payments for 6 to 12 months. You can also become an authorized user on someone else's account. This provides you with a credit card in your name, but someone else owns and is responsible for the actual account. If the primary account holder uses it responsibly and has good credit, it may provide a slight boost to your credit scores. You can also get a cosigner. Ask a friend or relative with good credit to cosign your loan. A cosigner promises to repay the loan if you don't, but make sure you follow through and don't burn any trust. You can also apply for a credit card at a store or a gas station. These credit cards typically have a lower credit limit and they have a higher annual percentage rate. That's the APR. It may be easier to get approved for one of these cards than the other types of credit cards. Finally, you can make a large down payment on a purchase and negotiate a loan for the balance of it. So offering to make a large down payment can make it more likely that a lender will provide your lending or will approve your lending application. And you'll not have to borrow as much money. For example, if you're buying a used car for $5,000 and you have enough cash, you might consider making a down payment of something between like $1,000 and $3,000 and then take out a loan for the rest. Repaying that loan as you agreed to can help to build your credit history. So let's talk now about credit cards. A credit card is a revolving line of credit. The balance on your card goes up when you make purchases. The balance on your card goes down when you make payments. There's a limit on how much you can borrow on the card at one time. That's called your credit limit. It can also be called a credit line. You have to pay at least a portion of the bill every month. That's called the minimum payment. A credit card can be an important financial tool because regularly paying your bill so the creditor receives your payment by the due date, it builds evidence that you are creditworthy. But the opposite is also true. If you don't pay the amount due so the creditor receives it by the due date, you can damage your credit history and decrease your credit scores. A credit card can also help you pay for emergency expenses when you can't pay them in cash. You do need to pay the credit card bill eventually, though. It also offers a convenient option for paying for purchases made online or by phone. Also, with a credit card, you have the right to dispute credit card charges that are wrong. And you have the right to dispute certain charges for goods and services that weren't delivered as agreed. So here are some basic steps for managing your credit card effectively. Make sure you keep good records. Check your monthly statements for mistakes because they do happen. Pay your credit card bill on time and pay at least the minimum amount due each month so that the creditor receives your payment by the due date. Try to limit how much you owe compared to your credit limit. Some experts advise using no more than 30% of your available credit. Others advise using no more than 20%. While keeping the balance on your credit card at or below those percentages may not always be realistic, it helps you to use as little of your credit limit as possible if you want higher credit scores. My parents actually kept their credit card frozen in ice in the freezer so that they'd have to think about it for a whole day while that ice thawed out before they used it. Now we'll talk a little bit about debt. Debt can affect your financial situation because you'll probably need to use income you receive in the future to make payments on your debt. You'll generally pay interest and sometimes fees on your debt until you pay it in full. It can impact how soon you can achieve your goals. There are two general strategies for reducing debt. The high-cost debt first method is when you first pay off the debt that has the highest cost to you. To use this method, first, you make a list of your debts in order from the highest cost to you to the lowest. The highest cost debt is usually the debt with the highest interest rate. Then you pay the amount due on each debt you listed so the lender receives it by its due date. Then if possible, with any extra money that you have that month, make an extra payment to the first debt on your list. That'll be the one with the highest cost to you. After you pay off that first debt, you work down the list and make that extra payment to the next debt on the list. You'll do this until all of your debts are paid off. The snowball method is when you first pay off the debt with the lowest balance. To use this method, you're going to list your debts in order from the lowest remaining balance owed to the highest and pay the amount due on each debt you listed so the lender receives it by the due date. Then, if possible, make an extra payment to the first debt on your list. That'll be the one with the lowest balance. After you pay off that first debt, you'll take the amount that you used to pay towards that debt that you've now paid off and apply it to the second debt on the list. When that's paid off, you apply all of that to the third debt, and so forth until you've paid off all of your debts. Note that both strategies work best if you avoid getting any more debt while you work to pay down the debt you already have. Several things can happen if you don't pay your debts on time and as agreed, including having to pay late fees or paying more money in interest, being contacted by a debt collector who asks you to make payment, losing services and having to pay costs to reestablish them, losing collateral, negative entries on your credit reports, a drop in your credit score, lawsuits from creditors, or even wage garnishment. Finally, I want to talk about something that ends up getting a lot of people in trouble during this transitional time, something called high-cost debts. High-cost debt is often the result of small-dollar, short-term loans that have either really high fees or high interest rates, or sometimes both. Now, the first kind is car or vehicle title loans. A car or vehicle title loan is generally a loan for a small amount of money and for a short time. You give the lender the title to your vehicle, for example, your car, your truck, your motorcycle. But then if you can't repay the money you owe, the lender can take your vehicle. Lenders charge a monthly fee. This fee can be 25% or more of the amount you borrow per month. If you can't pay off the loan in full when it's due, the lender may offer to roll over the loan into a new loan. And then that process adds fees and interest to the amount you originally borrowed. 1 in 5 single payment vehicle title loan borrowers has their vehicle seized by the lender when they can't repay their loans. The second kind is payday or payday advance loans. These are short-term, small-dollar loans. You borrow money now based on the expectation that you'll pay off the loan when you get your next paycheck. These types of loans are dangerous and often end up costing you much more than they benefit you. Please try to seek other solutions before taking out these two types of loans. This brings us to the end of our discussion about borrowing, credit, and debt. Do what you can to make responsible decisions and work on a budget that will help you to keep your credit in line and avoid adding a lot of debt to your monthly obligations. Thank you.